Welcome to Stocks in Translation, Yahoo Finance's latest podcast that cuts through all the noise so that you can make the right decision for your portfolio. I'm Alexandra Canal, in for Jared Blickery, and today I'm very excited to be joined by James Egan. He is the US Housing strategist at Morgan Stanley, along with our fab producer, Sydnee Freed, as well. Thank you both so much for being here today.
Thank you for having me.
Yeah, well, I'm excited because we're talking about one of my favorite topics, which is housing. And we have seen continued weakness there as interest rates remain high, demand has been muted, but that all could change with the Federal Reserve poised to cut interest rates in September. That brings us to our phrase of the day, locked in and priced out. That's how James Egan describes the current housing market, so we'll dig into exactly what that means. And this episode is brought to you by the number 5.2%. That is how much prices for the shelter index have risen year over year, according to the latest CPI print released on Wednesday. But let's get right to it. Housing industry. I want to start broad here. How would you describe this moment that we're in right now?
One of the words that's been overused for the housing industry over the course of the past 2 years has been unprecedented. But in a lot of instances, a lot of the key variables that we use to think about where home prices are going or where sales volumes are going, those inputs are either at levels we've never seen before or they're levels that we haven't seen in decades. We used the term locked in and priced out. So much of the housing market depends right now on affordability and supply and kind of the intersection of those two variables.
So let's dig into that phrase because I love it. Locked in, priced out. Can you break down exactly what this means?
Absolutely. So one of the big discussions in the housing market in 2022, the beginning of 2023, as mortgage rates and interest rates themselves were increasing as quickly as they were, as substantially as they were, affordability was deteriorating, right? We think about affordability largely three inputs: mortgage rates, home prices, and incomes. And the mortgage rate component of that, we had home price growth at record highs. Now mortgage rates are increasing as well. Affordability deteriorating faster than we've ever seen it. We're comfortable with that about 40 plus years. Never seen affordability deteriorate that fast. And the kind of consensus thinking was home prices have to fall. Affordability bad, home prices come down. And then the lock-in effect is what has kept home prices, or has played a big role in keeping prices as elevated as they are.
So how did we get here? Was this sort of a slow burn? Was it something that really started around the pandemic? Was it surprising, unsurprising? Sort of how did we find ourselves in this moment?
Hindsight is always 2020. I think if you had asked housing strategists, people in the mortgage industry that I spend a lot of time talking to, if you had asked them in 2019 that we would hit an all-time pace of record If you had asked them in 2019 if we would hit a record pace of home price growth in 2021, 2022, nobody would have said that. The pandemic kind of touched off a perfect storm. You had the Fed cutting, mortgage rates falling to historic lows. At the same time, now you have a pandemic that has people effectively wanting to leave more densely populated urban areas, go to places where housing is a little bit less densely concentrated because of just wanting to effectively distance from other people, the willingness and ability to work from home, meaning that people didn't have to be as close to their office. And on top of that, we were already if we were having this conversation in 2019, one of the things that I would have said was, we're in a historically tight supply environment in the housing market. We haven't been building enough homes, and the number of homes listed for sale has never been lower. The pandemic hits, and that resets to an all-time new low. It looks as if there is a typo in some of the charts that I publish because of how little homes there are. So you have demand for single-family shelter. The historically low mortgage rates means that the buying power of that demand is up, and all of that demand is materializing into the tightest supply environment we have ever seen, sending prices even higher.
So as someone who doesn't fully understand everything about the housing market, can you talk about how supply is determined? Who determines how many houses to build? Is it federal? Is it state? Is it local? Is it a combination? How does that work?
That's an incredible question because I think it feeds into, we talk about an undersupplied housing market so much, but I don't think we spend enough time kind of breaking out all of the different pieces to that. Now, we think there are three components to supply. We talk about the listing of existing homes for sale, so the people that currently own homes, are they trying to sell their homes? There's the building of new homes. And then the third prong, we call it the shadow inventory. That's kind of distress, foreclosure. We haven't seen a lot of that. We don't expect there to be a whole lot of that. We focus on credit availability as kind of one prong of our housing analysis. Lending standards have been very robust since the great financial crisis. Regulations have been put in place over the course of the past 15 years that have made some of the, we'll call them late cycle excess type mortgage products, short reset arms, negatively amortizing mortgages. They just don't exist in nearly the same volumes as they did in 06, 07, which in our view is going to prevent a fair amount of that shadow inventory, that default and foreclosure. So now we're stuck with listing of existing homes, building of new homes. That's going to be much more kind of hyper-local in terms of building regulations, zoning, HOAs. Like it's much more of a local government, not a federal government issue from a supply perspective.
And existing is hard right now, right? Because mortgage rates are high and no one wants to leave. Is that accurate?
And we would say that they are locked into their low mortgage rates. I've used locked in a couple times, and I actually never defined it at this point. And so that is the lock-in effect. You have historically low rates in 2020, 2021. The move away from those kind of short reset adjustable rate mortgages into 30-year fixed mortgages, borrowers taking out 2%, 3% handle mortgages for 30 years. Mortgage rates went up to 8%, they're at 6.5% now. If you want to sell your home, when you buy a new home, in almost all instances, you have to pay off that mortgage, that 2.5% mortgage. You have to take out a 6.5% or 7% mortgage on the new home. That's prohibitively expensive for a lot of households.
The math ain't mathin'.
The math doesn't math. And so you're sitting there and you're locked into your current mortgage rate.
So let's talk about the Fed and the role that they could play in potentially lowering some of these mortgage rates. How much can that impact? If the Fed starts lowering rates, they are poised to do that at the end of their September meeting. How much of an impact will that have on rates, and will that be an immediate change?
So the way that the Fed and Fed policy and the Fed funds rate, the way that we think about that specifically from the mortgage rate point of view is through markets' expectations, right? The Fed has not done anything yet. We very much expect them to cut in their meeting next week. Our economists have been on a 25 basis point cut for quite some time now. They're still forecasting 3 25 basis point cuts at each meeting into the end of this year, 4 25 basis point cuts to kick off next year. But despite the fact that the Fed hasn't moved yet, from the fourth quarter of 2023 to today, 30-year mortgage rates are down over 150 basis points. The 10-year Treasury is down about 140 basis points. So all of that is kind of expectations that have driven that part of the interest rate curve lower. And when we're thinking about mortgages, the part of the curve that we're going to be most concerned with is kind of the 7-year and 10-year part of the curve. So when we look at market expectations now for the Fed, our economists expect 7 25 basis point cuts over the next year. I looked at it before I came to your studios. The market's pricing in roughly 9 cuts by the middle of next year. That's 225 basis points lower in the Fed funds. 10-year Treasury, the swap curve has it down 7 basis points. So we would argue that actually most of the Fed cutting at this point in time seems to be priced in. So it's the market getting used to 6.5, yes.
I'm stunned because for a long time when we've been talking about rates, I feel like people were saying when they start to cut rates, that's when we'll see relief in mortgages. And then all of a sudden I started hearing this term priced in. It's already priced in. And I think I just got confused all over again. So it's the expectation that matters for mortgage rates. Can we back up then and talk about how mortgage rates are even related to the federal funds rate? Because I guess that's what is problematic in my brain right now.
No, I mean, I think it's the right way to kind of be walking through the relationships to everything here, right? So the federal funds rate, we're talking about the shortest term interest rates that we have, and mortgages, most of the mortgages underwritten right now, over 90% of the outstanding mortgage market is effectively 30-year fixed rate mortgages. So at least in the United States, we don't price mortgages off of Fed funds like some debt instruments might be priced. We don't technically price them off of any interest rate, but given the duration, we think about the 7-year Treasury. We think about the 10-year Treasury. And if you look at the relationships between Fed funds and the 2-year part of the interest rate curve versus the 7 and 10-year part of the interest rate curve, like there are relationships there, but those relationships change over time. We've had an inverted curve for quite some time now with the front end higher than the 10-year part of the curve. That is moving towards uninverting at this point in time. But as the market expected some of this behavior from the Fed as inflation came down, as the labor market slowed, we've seen a lot of that kind of 10-year and mortgage rate behavior. Again, mortgage rates are down 150 basis points since the fourth quarter of last year. The Fed hasn't moved yet.
So what happens if expectations don't meet reality? That's my one question. And then my follow-up to that, the expectation that the Fed is going to cut by 25 basis points. What happens if they cut by 50 basis points.
So my research answer at first is going to be, it depends on why they've cut by 50 basis points. Is it because the labor market is a little softer than they thought, right? The Fed's looking at the labor market, they're looking at inflation. You started with the number of this episode, 5.2%, kind of the shelter inflation number. It is something the Fed is definitively considering. I think that what you could see is a world in which you'll get a little bit more volatility, especially with the market expecting 25 basis points. You could get a little bit more volatility, which could lead to a little bit more volatility in mortgage rates, could lead to potentially lower mortgage rates there. I think one of the, I don't want to say frustrations, but like unique aspects of the housing market right now, going back to that locked in and priced out point of this, so many mortgages, record amount of mortgage origination in 2020, broke that record in 2021. Historically low rates, everybody wanted to jump in. As rates went higher, people aren't listing their homes for sale because they don't want to step out of that low rate. People aren't refinancing. Refinancing is, yes, you can cash out and take money out of your home, but mostly refinancing is to react to lower mortgage rates, right? So now there just aren't as many mortgages getting originated. So as mortgage rates come down from 8% in the fourth quarter of last year to 6.5% now, we haven't brought a lot of borrowers. There aren't a lot of borrowers with 7% mortgage rates. So they're not listing their homes marginally more or refinancing marginally more. 80% of borrowers still have a mortgage rate below 6%. So, and 75, like, when you look about below 4%, the effective mortgage rate of the entire country is still below 4%. So rates have to move a lot more significantly from 6.5%, 6.25%, where they are now, in our mind, to really kind of unstick the housing market.
Well, we still have much more ahead, but we're going to take a quick break right now. Coming up, housing inflation still isn't easing. We'll talk about the latest affordability issues. That's next. Welcome back to Stocks in Translation. The latest inflation data shows that housing is still very expensive and sticky. Shelter costs, the biggest contributor to overall inflation. Rent prices not coming back down. Jim, why have we not seen some of that relief, especially when restrictive monetary policy it's working for other areas of the economy?
So I think there's two answers to that question. One is how restrictive monetary policy makes itself felt in the housing market. Because if you look at home prices, it doesn't look like it's played a role at all. Home prices haven't come down, we're at record highs. But if you look at housing activity, so sales volumes, starts, the types of actual housing numbers that feed into GDP, for instance, those have fallen significantly. Sales volumes especially, we're at our lowest level of sales volumes. 2023 was the lowest level since 2011. And that's the lock-in effect we talked about, right? People aren't listing their homes for sale, so transactions can't happen. But because transactions aren't happening, we're not remarking the housing market. People are just saying, I don't need to sell into the lower prices that affordability would theoretically put on the market. But then the other part of this is rents, right? 65% of the country are homeowners, 35% are renters. Rents are largely what go into the shelter inflation numbers that we're talking about here. And there are two big components going on with rents. No inventory in the single family market. Multifamily starts have been at multi-decade highs for years. They've come down in 24, but they've been at multi-decade highs for years. But they haven't been finishing the builds. I can look at building permits and housing starts, and then before they get completed, there are units under construction. And the gap between starts and units under construction has ballooned to a level that we haven't seen. That data goes back to the 1960s. And it's just because those building timelines are elongating. That can be because of labor shortage issues. It can be from regulatory issues. It can be supply chain issues that the pandemic brought on. All of those are contributing to this. But you have, while that supply is coming online, that is helping rent growth slow down. We've seen shelter inflation slow. That supply shortage played a role initially. But the final piece of this, if we think about how people typically exit rentership, it's to go buy a home. You mentioned first-time home buyers. Not a lot of inventory. That inventory is very unaffordable. I don't want to say they're stuck renting, but you have a renter base that does have to keep renting year over year, and that we think could be providing some upward pressure to that rent number.
And just to take a step back here, you mentioned housing starts, building permits. There is so much housing data out there. It's hard for me to keep track of, and we always seem to have a mixed bag when it comes to some of that data. What should people be focused on when analyzing the strength and or weakness of this market? Is it all mortgage rates? Is it housing starts? Is it existing home sales? There's so much data out there.
That's why I can focus on something new every month and it doesn't get stale. So I think that mortgage rates are an incredibly important aspect of this. Yes, the bulk of outstanding mortgages are so far away from where we are right now that it's going to take some time, but still a number that's important to pay attention to. If I were to pick one number from a home price perspective, home sales perspective, we're looking at the listings of existing homes for sale.
Okay.
The reason that home prices have been as high as they are is because people are just unwilling to sell their home at the lower prices that affordability would say right now. If we start to get more people listing their homes for sale for any number of reasons, that's going to unlock the existing home sales market, but could also start to bring down home
The trickle
prices.
effect.
Yes.
Got it.
So is it better, this is too basic of a question, but is it better to rent or buy right now?
From an affordability perspective, if you are thinking about it today, in most places in this country, it is more affordable to rent than to own a home.
Wow. I mean, that makes sense. We have been talking a lot about from a buyer's POV about the housing market, but I am curious about the investing side. How does a beginner invest in the housing market? That's a thing?
So yes,
That's a thing I hear.
There are a few ways to do that without buying homes yourself. Now, I'm a fixed income research analyst, so I can't sit here and talk about single name stocks. One of the bigger changes in the housing market over from where we are today versus where we were 16 to 17 years ago before the great financial crisis, and there are lots of changes, but one of them is kind of the institutional ownership of single family rental homes. Single family rentals are not new. Though I think one of the stats, as I've kind of come up in this space, that surprised me more than anything was just how many households. I grew up outside of New York City. When I think of a renter, I think of somebody living in one of these 100, 200 unit buildings in Manhattan or Brooklyn, right? Back in 2006, when it was never easier to qualify for a mortgage, a full third of all renter households in the country were single family renter households. That's 11 to 12% of all households. We're talking over 10 million, I think it was roughly 13 million households lived as single-family renters. This has always been part of it, but the institutional aspect of it, that introduces a new way from an equity market perspective. I can't speak to valuations. I cover mortgage-backed securities markets, which do allow for some angle there, but that's an angle for institutional investors. So I think this is going to be more of a home builder, like rental operator REIT, and then the extent to which those exist in various ETFs. But unfortunately, I can't speak to the...
Yeah, no, that's great. It's just like a basic understanding of how someone can do that, because we talk a lot about buyers, but not always the investing side.
Right, and outside of
Right.
the stock market and the traditional ways of investing as well. And when you think about regionally, are there certain areas in the United States that are more affordable than others? And I always think of city versus suburbs. We're here in New York City. Obviously, it's very expensive, but I have heard anecdotally from my friends that are starting to move out to the suburbs, they're getting into bidding wars out there. I mean, because of the lack of supply, whereas maybe because of this exodus from the city, is it more affordable to be in the city? How do you look at regions?
So I would say that I love the way you finished that question, because how you look at regions becomes incredibly, I don't want to say nuanced to make my job sound more complicated than it is, but it is very different, because living in New York has always been more expensive than living in insert your southeastern MSA here. However, what we've seen over the course of the past 4 years is the rate at which affordability has deteriorated has been incredibly different. People trying to leave more densely populated areas. In 2022, I could have shown you a map of the United States by the number of people per square mile. And not the lower that was, the better your HPA was, but if we controlled for just suburban and urban, suburban MSAs did incredibly well, massively outpaced from a home price appreciation perspective, more densely urban areas, because people wanted to move out to those single family homes where there wasn't any inventory, so those bidding wars were incredible. So if I think the pace of affordability deterioration was a lot worse in the suburbs than it was in urban areas. Urban areas are still very unaffordable, but relative to history, they're less unaffordable versus those suburbs than they have been.
Okay, that's good to know. At least context is everything. But now we are going to move on to a segment that we like to call Who Wore It Better? And since we're talking the housing market, I want to talk about supply versus demand. Obviously, they're both very weak right now, but is there one side that is seeing a bit more relief than the other? Do they always work in tandem together? Where could we start to see some divergence?
So I don't think they always work in tandem together. And I think that that's an important aspect of why, for instance, prices can be so strong while sales have been so weak. We look at housing through what we call our 4-pillar framework, which is demand, supply, affordability, credit availability, to make sure that we're looking at all those lenses. But from a Who Wore It Better perspective, there's more relief on the demand side right now. We think that the housing market has a supply problem.
Okay.
Yeah.
And real quickly, you mentioned in your notes to us that there's a difference with what could happen in the housing market when it comes to a hard landing versus a soft landing. We like to talk about both options here at Yahoo Finance. So if you can quickly lay out what you expect in a hard landing and how much that differs if the economy does reach a soft landing.
It's exactly from what you just said with supply and demand. Are they working in concert? Are they not? Magic rate from a mortgage perspective, like are rates coming down because the Fed is easing because they've achieved a soft landing, or are rates coming down because there is a hard landing and we need to provide accommodation, right? From a hard landing perspective, I would expect as rates come down, I do think you're going to see more inventory. I don't think it's going to be as distressed as it was in prior cycles, so that's not necessarily going to be very detrimental from a home price perspective, but in both the soft and hard landing, inventory starts to pick up. In a hard landing, there just isn't the same demand response. So I think you're going to see home prices. We think that home price growth will slow as that supply comes on, but it's still growth. We're at 5.2 is the magic number for this episode. 5.4% was the home price appreciation number that we got from Case-Shiller last week, I believe. Maybe it was 2 weeks ago. We think that number comes down to 2% by the end of the year. Hard landing, more of our bear case scenario, you're talking down low to mid single digit percents. I don't think you're going to see, because we don't think you'll see as much foreclosure REO activity because of how conservative lending standards have been. I don't think you're going to see the down 10, down 12% home price year over year in that hard landing, but that lack of demand in an increasing supply environment leads to a little bit of a decrease.
Just under 30 seconds left here. What's the one takeaway, housing market takeaway you want our viewers to know?
The housing market is on a healthy foundation. The mortgage credit standards have been conservative. We don't think you're going to see a lot of delinquencies and defaults. On the same token, that is contributing to why we just don't have enough supply. Like whether it's building more, we think we're underbuilt by anywhere from 1.5 to 6 million units, or listings. That's keeping the housing market on a healthy foundation that won't see a correction in home prices in our view, but it's going to keep activity muted. We think that as rates have come down, activity will pick up, but that pickup is going to be gradual over the next 12 or 24 months. We don't see that massive rebound in sales coming while home prices continue to climb, but slowly.
All right, Jim, we're going to have you back on the pod for an update on this, because I could keep talking about this for hours. But Jim Egan, US Housing Strategist at Morgan Stanley, thank you so much for joining us on today's episode of Stocks in Translation. And that does it for us, but you can still catch all of our episodes wherever you find your favorite podcast. We are on the website, the Yahoo Finance app, along with YouTube, Apple, Spotify, iHeart, Podtail, Pod Paradise, and more. That's all for now. Keep it right here on Yahoo Finance.